In today's video, I am going to be breaking down a crazy stock that you may like. I don't personally invest in it myself, but I do watch it quite often, and it is quite interesting. It just had a massive day, up 5.5%, which means that it's no longer a 12% dividend stock, it's around 11.5%. So let's get down and let's check this out. The stock I am talking about is on the New York Stock Exchange. Its ticker symbol is RC, Ready Capital Corporation. Currently has an 11.3% dividend, which is still absolutely massive. And its PE ratio versus others for what it does, which we'll go over in a second, is actually really low right now. Its average volume is over 1 million shares traded per day. And on Friday, which is the day that, of course, we're breaking this down, had 1.4 million shares traded. When it comes to their earnings, they've had 3 beats and 1 miss, and in the past year, in 2020, they had record revenue, which had lower earnings, but cash is king. The more revenue that they have, they can always flip that switch and make more money. Now, what does this company do? Ready Capital Corporation, together with its subsidiaries, operates as a real estate finance company in the United States. The company originates or acquires, finances, and services small balance commercial loans, small business administration loans, SBA loans, and residential mortgage loans, and other loan or mortgage-backed securities. So basically, overall, it's a company that can deal with REITs or with the average everyday person looking to buy a house. And I think that this could be huge coming up very soon because, of course, interest rates are rising, which they would probably make more money, but there is still a massive housing shortage, and there's lots of millennials like myself who, of course, are looking for houses. I'm looking for a place out in the country that has enough room where I can build my own indoor basketball court for my basketball training company that I run. But companies like this are going to do extremely well because there's the older baby boomers who are not getting rid of their houses, and there are, of course, younger people who are looking to get into the housing market, and that then means that companies like this are going to be making even more money soon, especially with interest rates rising. Now, in the 5 years prior, it didn't do too badly. It basically started under $15 and it ended up being well over $15 before, of course, the massive drop that we seen. It also tends to trade in line for the most part. Of course, we do see times where it does spike above its average, but it generally trades within a range. If we extend this range out, we can see that, of course, it's back below its range. So right now, and of course here, obviously hindsight's 2020, seems to be a good time to buy if it continues to trade within that range. If you're, of course, an investor who doesn't look for massive growth, but a massive dividend. If we zoom out a bit farther, we can see that there was a little bit of growth that was happening before the big correction that, of course, happened right there. Its dividend is not always going to be the exact same, so we have to keep this in mind as well. It generally pays around 40 cents a share. It's up to that range right now. However, there are times where it does pay a lesser dividend, and we do see that quite often. We do see non-interest expenses rising as well, so that could mean that they are looking to continue to expand their business, which would always be a good thing as well. Now, while 2020 was a good year, 2019 versus the year prior was not that great of a year. So, what I like to look at this at is, of course, total revenue in a pandemic year seems to be actually pretty solid considering the prior year. So this just seems like a very interesting stock. It pays a very high dividend, and it pays pretty well and pretty solid. There are times where it does dip its dividend, but it tends to recover quite fast. Now, how I would look at this is it's not a business I would personally invest in at this point in my life. I'm 31, almost 32 years old, and I want to see some growth on the underlying stock. I would love to have a 10 or 11% dividend, but I want to see some growth, and a 1% growth on my underlying asset is not good enough for me. I want to see at least something that beats inflation. So still at this point in my life, I would lean towards the Canadian banks because they pay roughly around 4% right now, depending on which one, of course. And they are basically in the same business and they do more of it. So in my opinion, the Canadian banks are still better for Canadians, but if you're American, this seems to be pretty solid. I hope that you've enjoyed. If you have, hit that like button and subscribe, and I'll see you guys again next time.